This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
We're on page 89, Internal Audit, Chapter 14. We already talked about internal audits. We've talked about them in terms of reliance upon other people, reliance upon experts. And remember, internal auditors are part of internal control, and the external statutory auditor is going to want to place reliance on the internal audit function in order that they may be justified in relying upon the systems of internal control and accounting systems to produce properly maintained accounting records. And if they can rely on internal audit, then we can reduce the scope of our substantive work by raising our materiality level. So internal audit is a big area, and every time an audit firm, audit team goes out to a client to conduct an audit, they need to consider the strengths of the internal controls, and one of those controls is the internal audit department. And they still have to consider the strength of the internal controls, whether an internal audit department exists or not, because those stronger internal controls will help us reduce the substantive work. Again, even though the client may not be sophisticated and, inverted commas, a big client, nevertheless there should be some sort of internal control, but it may be that it's a disorganized organization and there are no internal controls, in which case the external auditor will still consider the fact that there continues to be no internal controls, and therefore we have to do a full substantive audit. Internal audit then, Chapter 14, considers the situation where there is an internal audit function, and public companies in the UK, under corporate governance, public companies should determine the need or the desirability for having an internal audit function carried out. Not an internal audit department established, because that's also one of their considerations, but whether if they don't have an internal audit department, should we nevertheless pay to have an internal audit function carried out, in which case they could ask their existing auditors, their statutory auditors, to conduct an internal audit, or they could approach a different firm and say, will you come and do an internal audit whilst we still continue to pay our statutory auditors? That's the situation we're in, and we're considering the work of the internal auditors. Chapter 14, page 89, the opening paragraph then. It's an independent appraisal function established within the organisation to examine and evaluate activities as a service to the organisation. It functions by examining and evaluating the adequacy and effectiveness of other controls. The establishment of an internal audit function is seen as good corporate governance, but having established the function, we then need to determine to whom the internal auditors should be responsible and reportable. And the common sense answer is that we should report, if there is one, to the audit committee initially, and the audit committee will then pass on the internal audit findings to the full executive board. Types of internal audit. It could be involved in a number of activities. It's easy to see that the work that the internal auditor does is of a typical or similar nature to the work of the external auditor. But the internal auditor has the luxury of being able to spend longer time than the external auditor, and can therefore look in great depth at systems and controls and documentation and the compliance of the processing of documentation in line with the accounting system which has been laid down. The external auditor doesn't have that luxury. So whereas an external auditor may select a sample of, say, 50 items for review, an internal auditor can look at 500 items, or 4 months, or 6 months worth of transactions, and far greater detail than is available to the external auditor. Compliance auditing concerns with the compliance of procedures with the internal controls as established by management. Now, management in my simplistic mind, management are concerned with managing a company. They're concerned with production, with sales, and maybe with human resource, and they're concerned with health and safety, but they're not necessarily adept or competent in designing a system which helps to secure the reliability of information. They may not have a financial background. So the designs of systems in order to secure reliability is not necessarily within the immediate experience of management. And so management will delegate this to an internal audit function. And the internal auditor, typically with a financial background but not necessarily, the internal auditor will be charged with the responsibility of investigating how things work now and working out or deciding how things could be improved and strengthened and recommending the implementation of these improvements. And it will then be management's decision, shall we accept the internal auditor's recommendations? And they would be wise to, and if they choose to implement them, then the internal auditor will see that the implementation has been done correctly and the system is now working satisfactorily. So compliance auditing, the internal controls laid down by management, in practice I suggest that it would more likely be a system which is recommended or designed by an external auditor, or in a bigger company, by the internal auditor. The external auditor will review the systems to a lesser extent and maybe suggest improvements within the management letter. Efficiency and effective auditing. Efficiency concerned with determining whether resources are being used efficiently. For example, the auditor, the internal auditor, will be interested in determining whether costs are being managed. So it's the efficient use of the scarce resource of funds. Whereas effectiveness is looking to see whether the company has achieved the objectives that they set out to do. It's concerned with determining whether resources are being used to proper effect. Example, the auditor may consider whether it would be better for the entity to lease motor vehicles rather than to buy them. What is the greater effective use of this scarce resource, and is it proving to be effective? Operational auditing, it encompasses both efficiency and effectiveness. You've got there these two E's. What are the other two E's with reference to the world of auditing? We've got the effective and efficient here. What are the other two? Expeditious and economic. It encompasses both efficiency and effectiveness. The idea is the auditor is concerned with the whole organisation and not just with finance and accounting. So the use of human resource, to compliance with law and regulation, to paying attention to corporate social responsibility, looking at productivity rather than simply the finance and accounting aspects, looking at the other areas that a company is necessarily involved in, but is not necessarily a financial area. The relationship with external auditors, and the P7 is really an exam for external auditors, but we have to consider the impact of the existence of internal auditors. The external auditor, the objective for us, I shall say, is to form and express an opinion on truth and fairness of the financial statements. The view of the income statement, does it fairly reflect the activities of the company? The view of the statement of financial position, does it fairly reflect assets owned and liabilities owed, and the equity section? Reliance may be placed on internal controls, but it seems a shortcut to examining all the transactions. The work of the external auditor is restricted to testing by way of sample. We don't have that ability or time available to look in great depth. The internal auditor, however, the prime objective there is to advise management on whether major operations have sound systems of internal control. They will test transactions, but on a greater detail or greater depth. Test transactions to confirm the evaluation and to determine the implications of any system's weaknesses. Systems are designed to ensure the future welfare of the company rather than accounting for its activities. But there are similarities between the two branches of the profession. There are similarities. Both the internal and the external auditors carry out control testing, but to different levels. Both are concerned that the entity complies with control procedures, but to different levels. However, the external auditor is more focused on financial systems and financial statements. They both operate as professionals, and they both produce formal reports to be taken action on. Differences: as an external auditor, by definition, you're independent. You can't be an auditor if you don't have that independence. Independence is already talked about, we've already discussed threats to independence, but independence is an attitude of mind as well as a fact that if your sympathies lie with the client, then you really have to question your independence. If you are so close in your mindset that you have the client's best interests, I've got to be careful here, you have the client's best interests at heart and the long-term prospects at heart, you may be tempted to introduce in your own independent mind. You may find that you have a bias towards the client's thinking, and that won't do. There should be no bias within the mind of the external auditor, the independent auditor. So independence is an attitude of mind, and it's measured conceptually as well as factually. So the external auditor is not an employee, and the external auditor does not rely on an annual or monthly salary to be paid by the employee. Internal auditors work for and on behalf of the entity. They're appointed by management, they are employees of the management, and they are dependent upon their continuing employment to provide them with a salary from which they can spend money buying food and going on holidays, and whereas the external auditor doesn't have that dependence. Internal audit is not a legal requirement. It's a voluntary act by a well-organised corporate governance-aware company, entity, group. It's not a legal requirement, but external audit is. Internal auditors report to the board or ideally to the audit committee. The external auditor has the responsibility not to the board, but to the shareholders, the members, a direct responsibility to the members of the company. The responsibility is stated to be our responsibility is to the company, and we report to the members, whereas the internal auditors have a responsibility to report internally, ideally to the audit committee, but otherwise to the board. So there is a big difference there. Another difference is the scope of the work that we carry out. I mentioned already that the internal auditors have got this luxury of being able to spend whatever time is necessary in investigating particular applications within the system, whereas the external auditor can only skim and take a thin layer from around all those material areas of the financial statements in order to reach a true and fair opinion. Explain the reasons why internal auditors should or should not report their findings on internal controls to the following selection of entity officials: the finance director, secondly the board of directors, and thirdly the audit committee. Just jot down one or two ideas, and remember that you've actually got 3 questions there. In fact, you've got 6 questions there. Arguments why they should, and arguments why they should not, for 3 separate bodies. Meanwhile, I'll finish my coffee. Explain the reasons why the internal auditor should or should not. First of all, the finance director. Construct an argument in favour of the internal auditor reporting to the finance director.
But is it meant that it is reporting on regular basis?
At the end of each assignment that the internal auditor is carrying out. At the end of each assignment, I want an argument in favour of the internal auditor reporting to the finance director.
Because
because finance director is usually involved in all the financial related areas.
Is heavily involved, aren't they? The finance director is normally heavily involved in all financially related controls, and therefore also internal controls, in order to secure the assets of the company. And because of that close involvement, the finance director, he or she, is more likely to be able to understand the importance of the weaknesses identified and accept the recommendations made by the internal auditor. I can quite happily see that the finance director is the person to whom the internal auditor should report, because again, typically, the chief financial officer or finance director is likely going to be financially trained, probably, hopefully, a qualified financial accountant, certified or chartered accountant, and will better understand the implications of the internal auditor's recommendations. In addition, the finance director is the person who has at their fingertips the information that the internal auditor is going to be likely requesting. Would they want to know? Can we have copies of leases? Can we see what has happened to these particular transactions? The finance director is the one who almost instantly has the information available and the answers readily available to the questions that the internal audit department will be raising. So I think, without going any further, without even addressing the other 5 questions here, the argument why they shouldn't, or the argument about should or should not board of directors, should or should not audit committee, I think we've answered the question. The finance director is the person to whom the internal auditor should be responding, to be reporting. Does anyone in the room have any contrary argument? Good. Because having said that the finance director is the person to whom the internal auditor should be reporting, I'm now going to go 180 degrees different and say this is the last person to whom the internal auditor should be reporting. The arguments why you shouldn't be reporting. Why?
Because if there are any fraud activity,
If there is any fraudulent activity with reference to financing, if there is any creativity or manipulation, it's being done by the finance director. And one of the purposes of having the internal audit is to determine the security of the assets. He is the last person, she is the last person to whom the internal auditor should be directly responsible. Yes, there is an argument that says because they are financially orientated, financially trained, they will better understand the implications. But that's not the point. The point is to try to secure the assets of the company. And the finance director is the person with a finger on the finances. Just let me go back to the argument in favour of reporting to the finance director, and you know it's a non-argument. If you report, and therefore, I'll extend it actually, I'll extend down to the board of directors. If you're reporting to the board of directors is typically made up of the finance director and chief executive, sales, production, human resource, export, financing, whatever. So the board of directors is made up of a number of people with different specializations, different specialist experience, and they may not fully understand the implications and the importance of sound systems of internal controls. They may not, even when it's pointed out to them, it may not be immediately apparent to them why it is important there should be 2 signatures or 2 authorities for the raising of a credit note. It may not be instantly obvious why that should be so. So the board of directors do not necessarily have the experience or expertise fully to appreciate the importance of having a strong internal control system. And that's why I can see why you wouldn't want to report to the board of directors, why you wouldn't want to report to the board of directors. But the argument in favour is when you compare it with reporting to the finance director, the argument in favour is that these other people do have a wider experience or experience in wider fields. And it should not take too much of an educational process to point out to them why it is important that internal controls, a sound system of internal controls, should exist. So I can quite happily argue that it is preferable to report to the board of directors when compared with the reporting to the finance director in isolation. That they have a wider experience. The reason that they are directors, hopefully, is that these people are competent and they are experienced in business. An argument against is because it may be that they are busy in their own specialist areas and maybe don't recognize the importance, and maybe don't have the time to be acquainted with the importance of a sound system of internal control.
Maybe it should not be reported to finance director because internal auditors may feel that they could be punished or whatever.
That's a super point, and I wish I'd thought of it. I have in the past thought of it, but you've reminded me, thank you. There may be reluctance on the part of the internal auditor when reporting to the finance director as an individual, that if they are responsible and reportable to the finance director, they may fear for their job. They may refrain from being excessively critical. And don't forget, and there's a point I did raise, the finance director themselves could have designed the systems. And now to report and criticize those systems could give rise to internal mental fears on the part of the internal auditor. Thank you. I wish I had remembered it. I did know it, but I forgot it. Whereas if you report to the board, then that fear, if you're directly responsible to the board rather than to an individual, that fear is rather mitigated. You're not as worried about your continuing employment if you're reporting to a group of people. Then it comes down to the strength and power of the finance director. Are they a dominant individual on the board, in which case the issue still remains.
In favor for reporting to the board, maybe as the board of directors are direct representatives of shareholders in the company, so they should know about any findings.
It is, and I said it shouldn't be a major educational exercise to educate the non-financially orientated directors about the importance of internal control. They are people who are, hopefully, experienced in business, and the board of directors elected to that position by the shareholders are themselves responsible to the company, represented by the shareholders themselves, and therefore it is appropriate that you should notify the board of directors because they, as representative of the shareholders, ought to know about weaknesses, criticisms, strengths, improvements to the system. So it is appropriate, and far more appropriate, that we should be reporting to the board rather than to an individual. But even then, and we have therefore the third option, even then it may be that the board of directors is more inclined to concentrate on their own specialised areas, and the audit committee as the alternative, the third alternative is the wrong word, as the third option, the audit committee is surely the ideal person or body to whom the internal auditors should report. And I mentioned earlier, I think it was on Wednesday, I mentioned that the internal audit would liaise closely and report directly to the audit committee. And the audit committee would review the projected scope and the direction and the focus of the internal audit's work on a regular and frequent basis. So the audit committee is surely the ones to whom we should be reporting. This is reduced in effect if the audit committee itself does not meet on a regular, frequent basis. If they do, and if they do have their finger on the pulse of what's happening in the company, then it does make sense for us to report to the audit committee. These people are elected to the position of audit committee members because they are provenly successful in their own fields, not necessarily financial, but they're proven to be successful business people. Norwich City Football Club, which at the moment temporarily is in the Premier League of the English Football League, has a non-executive director who is a provenly successful businesswoman who writes cookery books. One might think that she knows very little about football on the basis that she's a cookery book writing expert, but she's actually been a supporter of Norwich City Football Club for many years, I think since she was a little girl. Cynics may then say, that does not mean that she necessarily knows anything about football if all she has done is watch Norwich City play football. But that would be a wrong thing to say. It doesn't matter what their specialist areas are. If these people are provenly successful in business, then it is appropriate they should be appointed as non-executive directors. And that being the case, they do understand the importance of internal controls, and surely they are the people to whom the internal auditor can report without fear of retribution, without fear of losing their jobs. By necessity, a lot of the work of the internal auditor will be financially orientated. That being the case, I've already established the finance director is not the person. But equally the board of directors is not the body, because only one of them is likely to be financially orientated, and that's the finance director. But if we report to the audit committee, at least one of whom should be, and if you look in Devro, the lady who's been recently appointed was a former partner at Deloitte's, then clearly she does have, and I think I'm right in saying she is the chair of the audit committee now. We'll just have a quick look and see. She was a senior audit partner at Deloitte's. She spent over 25 years advising global manufacturing companies, including businesses in the food and automotive sectors. She was the partner in charge of the UK manufacturing industry, responsible for strategy and marketing. Her extensive experience with manufacturing companies and her strategic work with Deloitte has given her a strong international business perspective. She will take over the role of audit committee chairman. Is that not a contradictory? She will take over the position of audit committee chairman. Should it be chairwoman? Or just chair? When Mr. Patterson steps down on the 19th of April 2012. So she is the person who will take over the chairmanship or the chair of the audit committee, and she's a vastly experienced, qualified person with wonderful experience in marketing, automotive strategy, auditing. She's an ideal person for the audit committee, for the chair of the audit committee, and to whom the internal auditors could sensibly report, knowing that this woman is able fully to understand the importance of the audit committee's the internal auditor's recommendations. I think I said audit committee. She is the person to whom the audit committee reports. She is the person to whom the internal auditor should be reporting, because she does understand the importance of internal controls and other finance and strategy. I mentioned that we could outsource the internal audit function. If we don't have our own internal audit department, there's no reason why we shouldn't outsource it. And there are a variety of ways in which an internal audit function can be arranged. For instance, we could pass on to an individual from within the company, just an individual, and say, will you carry out this particular internal audit project on a particular isolated instance? Will you look at it and determine where we could improve the strengths and weaknesses, or improve the strengths and resolve the weaknesses of this particular limited application? So an individual could be delegated the responsibility. We could allocate the job or the task to our existing external auditors, Therein lies a little bit of a problem which we're coming to or have already discussed. Or we can outsource it to another firm of accountants rather than establishing our own internal audit department. So internal audit is not mandatory. Many companies have decided to outsource or contract out the function. That may result in the external audit firm providing both external and internal audit functions. The advantages of outsourcing: some organisations are not big enough yet. Where do big companies come from? Have you ever thought of that? Many of you are parents, many of you in the room are parents already of children, and there will come a time when your young children say to you, "Mummy, where do internal auditors come from? Where do big companies come from?" And you have to answer them, you have to tell them, to give them the facts of life. Where do big companies come from? They come from small companies. And where do small companies come from? From individuals. And so it may be that in the process of an individual converting to a partnership, converting to a small limited company, and growing into a big limited company, a big group of companies, it may be that in that interim process of growing into a substantial company, it's not big enough to warrant and to justify, dare I say, a non-value added function. They're not productive, they're not selling, they don't generate income. Do you want to argue that?
Yes.
Good. Yes, you do want to argue. Let me guess that your argument is going to go along the lines of the internal auditors actually will tend to save money and improve efficiency and improve effectiveness and help to secure the assets of the company and therefore prevent the company from being the victim of fraud. So in fact, although they don't add direct value, their indirect contribution is to the benefit of the company. And it's a cost-benefit analysis that a small company growing up without internal controls is then at the mercy of evil individuals who will then try to misappropriate assets or divert funds into their own account. The internal auditors can help to prevent that. So yes, although it's not a direct value added in terms of production, units or volume, or in terms of selling prices or market share, they do have a valuable indirect contribution to make. Some organisations, though, are not yet large enough themselves to justify a separate internal audit department, and outsourcing is therefore the only really available, effective, appropriate means by which they can benefit from the internal audit function. By outsourcing, we're increasing independence. An internal auditor should be, as far as possible, should be independent of the day-to-day activities, and therefore they are reporting to the highest level. They're not reporting to some assistant secretary in the production department. They're reporting to the highest level, the audit committee. I met a former student on the street a couple of years ago now, and she's now an internal auditor of an insurance company over here, and she was telling me that her job is totally secure, that she has no worries about criticising the directors of the local company because she can only be removed from office by resolution passed by the board of the parent company in Switzerland. So it doesn't matter what she says within her report. She may be the most hated person in the organisation, but her job is secure unless she upsets the board of directors and the audit committee of the parent company. I think that's got to be one of the ambitions of any internal auditor, is to be the most hated person within the organisation. That strengthens their independence. And you as external auditors, any of you as external auditors, can determine the adequacy and reliability of the internal audit function by seeing whether the internal audit department is invited to the annual Christmas party, or do they have to have their own party in their own little internal audit room. Because they should be independent. There should be no relationship or friendships between the internal auditor and the day-to-day staff or employees of the company. The independence, therefore, of the function is enhanced, is improved, is strengthened because by being outsourced, for instance, if you outsource the function to, and I'll pick a name at random, Ernst & Young, whereas the auditors of the parent company or the group are, say, Deloitte's, then we have that separation of the internal and external. We don't have internal employees carrying out an internal audit function. We've delegated it to responsible, qualified people, Ernst & Young, from outside the group, and their independence is improved. Internal auditors, like external auditors, should seek to be independent. Mentioned already that they can't be if they are employees of the company because they are dependent upon a salary. But if you can outsource it and justify outsourcing it, then that would improve this, inverted commas, independence. The investigation of sensitive areas such as management fraud are easier if the person doing the investigation is not an employee, is not an internal person. External providers may have more access to specialist knowledge. They have a library, they have technical departments. But there may be disadvantages. Outsourcing appears to go against the spirit of governance. It's surely the director's responsibility to institute controls. Yeah, all right. But is that not part of governance? That one of the internal controls is the outsourcing of the internal audit function. It strengthens the role and the position of the internal auditor. I'm not sure about that top point. It regards regular monitoring of key controls by internal auditors as an integral part of the company's systems. Well, again, I'm not sure that that's a disadvantage. If we outsource it, we still do have the benefit of the regular monitoring of key controls. Using external providers may be more expensive because they're paid fees which include profits rather than being paid a salary which clearly doesn't include profits. External staff may change frequently. Yeah, if we employ Ernst & Young, there's no guarantee that the same personnel will come back on a regular basis, that as the staff of Ernst & Young changes, then new staff come along and they have to go through learning curves. So that could be expensive. Internal staff usually know the system better and therefore they can identify problems more easily. They're also closer to the daily activities of the company and may get earlier indications of developments or problems. Where are you going to find an internal auditor? This is not in the notes. Where are you going to find an internal auditor? Where would internal auditors be? From where would internal auditors be appointed?
From the company.
Yeah, from the company. I was teaching a course, I've forgotten where, I have a feeling it was Prague. I was teaching a course for a major international company, and on the notice board in the reception area were invitations that said things like, there are 2 spaces available for anybody who wishes to apply to be a position on the internal audit team. And they advertise it within the company before they start going outside to advertise it. There is a disadvantage there. There is a distinct disadvantage. First of all, they come with all the baggage. They come with all their knowledge and all their prejudices and biases and personal hatreds of other people employed within the company. And secondly, typically an internal auditor will be recruited from within the finance department. And that means that there is the situation where they are the hunted turning into the hunter. And they're looking at the work of what was their immediate colleagues, the people that sat at the desk next to them. And there may be friendships, there will have been friendships, which have grown over the years while they were still a member of the finance department. In addition, within the immediate period after their recruitment from the finance department to internal auditor, they will possibly be looking at their own work that they have done in the recent past. Did I do this properly? Can I criticize the work that I did last month? And clearly the answer is no, they're not going to. So they come together with all their internal prejudices and all their knowledge of the internal politics of the organisation. And so it's not necessarily a good idea to recruit from within. Recruiting from outside, the argument against that is that if you recruit an internal audit function or department from outside, There's a lot of learning to go through. Familiarization with the systems, familiarization with the documentation, the products of the company, the competitors, the suppliers, the employees who are responsible, learning about the directors and their integrity and reliability. There's a lot of work involved in a person being recruited from outside the organization to becoming an internal auditor. There are arguments in favor and against. If we had, in the past, delegated individual internal audit assignments to an internal person, or we'd developed and grown up our own internal audit department, and we then make the decision to outsource it, so we're going to close down the department and outsource it in its entirety, there is another argument against that, and that is that on the basis that a company is continuing to grow, then there may come a time in the future when they decide to re-establish an internal audit department. But we've just lost all the skills because we did have the department, we've got rid of it, we've outsourced it. Now we're deciding 5 years later that we can justify an internal audit department again, but we've lost all the people that are already knowledgeable. So we run the risk of losing the skills which have been developed. So there's an argument again against the decision to outsource the function if we already had the function internally covered. What are the ethical implications of external audit firm providing both external and internal services to the client? What are the ethical implications? Now, I know there's one of you in the room that I can rely upon to give me certainly one point here. What are the ethical implications?
Self-review?
Well, self-review that's not the one I was looking for. Money, thank you very much. The money aspect. Yeah, we have to keep an eye on the level of fees receivable as external auditors and internal auditors. We have to consider the fee levels, the 10%, 15% level. Thank you for your contribution, which said self-review, the threat of self-review, that as the external auditor making recommendations, the internal auditor then will look at those recommendations and the implementation of those and decide that the system is not yet strengthened, and therefore you're going to get people from KPMG looking at KPMG's recommendations, and one team, the internal auditors, are going to say about the external auditor's recommendations, these are not appropriate or these could be improved, and so you self-review. You will be hesitant to be critical of your colleagues. Another ethical implication? There could be an intimidation threat. There could be a threat to your independence in terms of intimidation. That if you lose the job of being internal auditor, then you're also likely to lose the job of being external auditor. So an internal auditor may feel reluctant to be openly hostile or critical, because if they are, it is potentially the case that management are going to say, we don't like the quality or the content of these internal auditors' reports. Let's get rid of Deloitte as the internal auditors, but they happen also to be our external auditors, so let's have a clean sweep. Let's change them completely. So there could be an intimidation threat. The management say, if you write that, either as external or internal, if you threaten to qualify your audit opinion on our financial statements, we're going to have you removed at the general meeting. We shall recommend that you be removed and replaced. Oh, and by the way, if you're going to lose your position as external, you could lose your position as internal as well. It's a big thing to lose both audit functions. Yeah, okay, you can live with the idea of losing one or the other, but to lose both could be quite dramatic in terms of finances coming into the firm. Any other ethical implications of the external audit providing both of the services? In order to strengthen the independence of both functions, quite clearly separate teams should be involved, and the internal and the external should not communicate in terms of the client's systems. There should be no internal communication like that in order to strengthen the separate teams. And that also involves then the separate partners, a partner in charge of the external, a partner in charge of the internal audit. We have another practical problem here, that if we engage the services of PricewaterhouseCoopers as the internal auditors, where do the internal auditors' loyalties lie? Do they lie internally with the client, or do they lie in an employment basis with PricewaterhouseCoopers? And if you're told as a trainee, a student, an employee of PricewaterhouseCoopers that your presence is demanded in the office on a Friday afternoon because we have to query something, do you say to your temporary employer, the client, I'm sorry, I can't stay here this afternoon, or this week, or this month, in order that you can go back to PricewaterhouseCoopers and do some PwC work? So, where are your loyalties? And that's a problem. I think the answer has got to be your loyalties would remain with your original employer, with the PricewaterhouseCoopers. Any other ethical implications? I don't know what I've written in the suggested solutions. I'll just have a quick look and see if I can dig out any more. Conflict of interest, we mentioned. Loyalties, I've mentioned. Instructions, where do you take your instructions? It's a bit like loyalties. If PricewaterhouseCoopers say, you've got to come back in the office because we need you on an external audit, where are you going to take your instructions from? And independence, I've mentioned already. So the printed solution at the back on page whatever it is, the printed solution covers what I've already just mentioned. Printed solution on page 108 of the course notes. I'll leave you to read page 92. So we can move on to 93. I just mentioned and talked about outsourcing internal audit function, but a client may outsource a number of other functions as well. They're typically something like data processing. And within this country, I'm aware of a number of data processing organizations who receive the data and process it on behalf of clients. And I believe there's a former partner from one of the big four firms who now works with a data processing company in this very city. I'm not looking at any of you individually or particularly to indicate which firm I'm talking about, but I think those of you who are involved will know who I'm talking about.